Hi, and welcome back to our channel, Pay Down Debt Solutions. I'm Jen, and today I want to bring some more velocity banking fun. Why wouldn't I, right? It's my favorite thing to talk about. Just kidding, guys, no. But it really is one of my favorite things to talk about, and Dan loves it too. It changed our world and changed our life so much. So I want to go ahead and talk to you guys today about thinking outside the box and how important it is when it comes to your finances, on how to think a little bit differently, because everybody knows what the definition of insanity is, right? It is doing the same thing over and over and over again and expecting the same or expecting different results, not the same results, different results. And so we know that doesn't work, right? It never works. If you think you're going to change your trajectory and start making a difference in your banking without doing something different, you're not going to succeed. And so we're going to change that for you. We're going to show you how to stop banking the traditional way so you can flip your negative cash flow to a positive, or that even cash flow to a positive, or that positive cash flow to even more positive cash flow to help you get out of debt. So that is what today's topic is really going to be about. So those of you that know who I am, again, my name is Jen, my husband Dan. We run this channel because we want to teach you about velocity banking, and we're doing it for free for you so you can get yourself out of the situation that you're in. Now, Dan is a business owner. He's an amazing, smart guy. He's run many businesses, and in some of those businesses, I then took over after a few years, and then I run some more of my own businesses that I have started and do that on my own on the side. So, but I also come to you with a different kind of knowledge. I used to be a banker, and then I was a branch manager for many years. So I do understand the financial world pretty well. And I really understand banking and the products that the banks have to offer. So what I'm bringing to you is a different way to think, a different way to think about banking, and it's called velocity banking. All right. So let's get into thinking outside the box and how this matters to you and matters to your finances. So, what I want to cover today is, again, changing what you're doing. And then I'm going to show you an example of how somebody changed what he's doing, and in two different ways, how he saved money, and one catapulted him a lot faster. And I'm going to show you what that was. Okay. So, the box is traditional banking, right? So we know that the box that we're all in is that traditional banking box, that traditional banking mindset where the banks want you to park your paycheck into your checking account, have a savings account, pay all your bills through the checking account, and then if you have anything left over, you're going to throw that in the savings account. Or if you have a little more than most people, they're going to want you then to invest it. So maybe you got an inheritance, right? They're going to come after that money. They're going to see it parked in your account, and they're going to try to get you to invest with them. And we can't be mad at them for it, right? They're a business. That's what they're there to do, is to run a business. And so that business is going to try to get more of your money. Well, the smartest way that they can do it is to have you keep a checking account and a savings account, because those deposits that you have on hand with them are what they lend out to other people through loans. Okay. They love loans. They're not as in love with lines of credit as Dan and I are, and as you guys are going to learn to be, because those loans pay them on an amortized schedule. And it's that amortized schedule that pays them all that interest up front, so they can then get their money and get more money so that they can loan it out to more people and make more interest off of us. Okay. So it's just business sense, right? It is business sense, but we can take back control, right? We can take the reins back and we can control this by reducing the amount of interest that they get from us. And we do that through a special thing called lines of credit, okay? And they're revolving lines of credit. That could be a credit card. That could be a personal line of credit. It could be a home equity line of credit, not a loan, a home equity line of credit, or it could be a business line of credit. So we have lots of options out there, and I'm going to help you navigate your way through this. So let's get into it today. Let's talk about thinking outside the box and how that's going to work for you, or how it could work for you. And I'm going to run an example about this specifically, how somebody thought outside the box. And I'm going to show you two different ways. I'm going to do a rundown for you right after this and clear this board on how he chose option A or option B. If he chose A or B, what those were going to look for him. Okay. So Today, the box is again traditional banking. It's traditionally doing what you're doing by parking your paycheck into that checking account and then paying your bills and everything that comes out of your account that way. Okay. And so I'm going to talk today about agility versus ability, right? Being able to pivot when you need to pivot so that you can be in better control of your finances. So, how do we do that? Well, part of that is thinking outside the box, making some changes to your finances to help you flip negative cash flow to positive cash flow. And I'm going to give you some ideas on that today. So be agile with your banking, right? Be agile. So there are simple ways you can increase cash flow without getting another job. So I don't want you guys to have to, take time away from your family and get another job. If you absolutely have to at the end of the day, I get it. And there might be times when you have to do that, right? That is where Dave Ramsey and I differ because I don't want you to spend any extra time away from your family. I want you to be able to bank the way that I'm going to show you how to bank so that you can spend more time with your family and not worry about whether or not you're going to have enough money to come in to cover your bills or if you're going to have the cash flow to, to take care of the what if moment that happens, right? So Dave Ramsey talks a lot about, putting that $1,000, having $1,000 in the bank for that oh shiznit moment, right? And he says it should only take you about 30 days to do that. But he's also asking you to sell a bunch of stuff. He's saying you should be able to just save that in 30 days and you'll have no problem. And then you're going to go ahead and move on to step number 2, right? Well, step 1 is where people get hung up because a lot of people don't have $1,000 extra to have as oh shiznit money. They don't even have it. So how are you going to go get that money? Well, he tells you to go get another job, so it takes away from your family. He tells you to sell everything you have. You might have to sell your four-wheeler. You might have to sell your boat. You might have to sell some of the antiques that you have. You might have to hold a garage sale, whatever. He's asking you to sell some stuff. And maybe that's okay. And maybe you're okay with doing that. That's fine. But if you don't have that $1,000 to begin with, then there has to be another way. And I'm going to go ahead and show you that other way. Now, there are things that Dave and I do agree on. And part of it is going to be what you see in step number 3, contributing to a 401k. And we're going to get to that in a minute. So when you're in debt, contributing a lot of money to your 401k doesn't always make the best sense. Always contribute if you have it available to you. Now, again, I'm not a big stock market person. I was for a long time. I think I told some of you that I hold a Series 6 and I was looking into a Series 7. I actually thought I wanted to be a financial advisor until I got wise about the ways of this world. And now I do things a little bit different. But I digress. Let's not talk about that. All right. So again, be agile with your banking. We're going to train you on how to untrain you from the traditional banking way. All right. So number 1 here, it says we're going to stop paying bills through your checking account. We're going to start using lines of credit instead. Okay. Those again are RLOCs, revolving lines of credit. So when I talk about an RLOC, that's what I mean. I mean a revolving line of credit. So we're going to use credit cards. We're going to use personal lines of credit. We're going to use home equity lines of credit, and we're going to use business lines of credit. Okay. We're going to use these as our debt destroyers. Okay. Now, the pay down way, Dan and my company, is Pay Down Debt Solutions. Our pay down strategy is a 3-step strategy. Number 1 is to organize your bills. Number 2 is to identify. Okay. You're identifying your debt destroyer, which is one of these. A credit card, a personal line of credit, HELOC or BLOC. Or then the 3rd step is going to be implement. So it's implementing your strategy and hammering down your debt. Very simple, super simple, right? Now, when you start getting into this at first, might look a little bit overwhelming, but that's what I'm here for. And that's why I have, over 60 videos out there to show you guys the way, help you navigate through this because you can do it. If I can do it, you can do it. And let me tell you, Dan and I were in a rough spot quite a few years ago. We had looked into bankruptcy actually because we were in such a tight spot and we had so many payments and we were so payment poor. We weren't sure how we were going to get out of it with everything we had intact. So we figured we were going to have to go through bankruptcy. We didn't. When I found Velocity Banking, I found a whole lot of answers and we saved ourselves all that time, effort, and trouble. And so we didn't destroy our credit in the process, which a lot of people do when they file for bankruptcy, or if they have a consolidation, company come in and help them, right? So don't do that either, because I can show you how to do this and save your credit, and build your credit in the process of doing velocity banking. All right, so we're going to stop paying our bills through our checking account, and we are instead going to park our paychecks on lines of credit. And I'm going to tell you about that in just a few. Those of you that already know it know that basically it's when you get paid, you're going to put all of your income into a line of credit, and you're going to pay all of that, those charges and those bills through that line of credit. All right. So number 2, we are going to cut all unnecessary subscriptions. Now, I've talked about this in the past, and I use my example of, all the streaming companies. You've got Hulu and Netflix and Amazon and Disney and all this stuff, right? And I said to you before, do you need it all? Do we need all of these though? Because all of those add up, right? When you start adding up all of those subscriptions, you start to get into a couple $100 maybe. Okay, so at least there's probably $100 worth of subscriptions you can cut out and save yourself some money. Okay, many of you got smart and share with other people, but now these companies are getting a little tricky, so they kind of know, they caught on to us, right? So they're getting tricky, but there's other ways. We don't need all the streaming companies, but man, if that's your thing, okay, fine, keep it. Look to trim the fat elsewhere. There's other places you can do that. For an example, last year I got a membership to a jump park for my kids. How many times do you think we went? Not many. So I'm spending monthly. I was spending a monthly charge, like 20 or 30 bucks a month, to have this membership to a jump park that we used maybe 3 times that year. Okay, so little things like that. Had we gone and spent, the times that we went, if we would go and spend the $30, I saved doing it that way versus having that membership. While you think it might be good, right? And that's how they get you. They sign you up thinking, oh, I can go there. It'll be free. It'll be great. But in reality and in practicality, if we don't do it, then we're just wasting that money. Again, gym membership. I have a gym membership. Dan and I put our own gym in our garage, right? So we have a heated garage. We put it in there. We don't even go. So we had a gym membership we forgot about that was hitting our accounts. And so we had to get rid of those. And we would have saved hundreds of dollars had we caught on to that earlier. So again, when you organize your bills through the pay down way, you're going to cut all of that and you're going to find cash flow. I can guarantee it. Okay. So 2, you're going to cut all that unnecessary subscriptions. Okay. So 1, we're going to stop banking the traditional bank way. We're going to bank velocity banking way. We're going to use the pay down strategy. 2, we're going to cut out all that unnecessary fat, right? We're going to trim the fat, get rid of those subscriptions that we don't need. So we're going to do that too. Now, 3, this is a good one here. And so we have a couple other ones, but I figured I'd just go with 3 today. So how many people out there are contributing to a 401k? I bet almost everybody is, right? The smart people out there are going to be contributing to their 401k, and they're going to be doing the match, if not more. So your company usually comes to you and says, okay, we'll match you at 3%, 6%, 10%, whatever. They're going to give you a percentage and they'll match whatever you put in. Okay. So it's their way of getting you, again, to put money on deposit with a bank. And that's why the banks do this, right? So you have a 401k that you contribute to. And so I remember when I got into, banking, I was a branch manager and a banker. And I'm like, yeah, I'm going to contribute 20%. That's what I'm going to do. I'm going to contribute 20%. My company matches at, I think at the time it was 5%. And so I was like, I'm going to do above and beyond that. I'm going to go 20%. I'll never feel it, right? And then I forgot about it. And I didn't make any changes and I didn't do anything with it. And had I done something different, right, when we started getting into debt, although truth be told, I was actually out of the banking industry by that time. But had I done something different, I might have been able to do more with my money and actually have more cash flow to then hammer down some debts that we had at the time, which weren't nearly what they were, a year or 2 later. So how much are you contributing to your 401k? Is it above the company match, and should it be? Again, I'm not going to get into, compounding and putting in money into a bank and go that route, but I am going to tell you, and Dave Ramsey does agree with me on this, right? That when you are in debt, when you're contributing to your 401k, yes, do the match, but don't do above and beyond that, because that's money that you can use to hammer down your debt, okay? And I'm going to show you an example of this later on. So this is a good one here, right? So number 1, let's address it, okay? So let's address not having any cash flow, okay? So you don't have any cash flow because you're paying the traditional way through your checking account. Well, there's a couple tricks that you can use. So maybe you don't have any cash flow and maybe you don't have any ability to get any other line of credit. But let's use this example here. So I have an example of somebody who has an income of $2,600. They have expenses, total expenses of $2,600, which means their cash flow is at zero. So how can this person ever get themselves out of debt if they don't have any cash flow to work with? It's going to be difficult, right? And so at this rate, in this example, it's probably going to take them 5 or 6 years at $94 and $123 to ever get out of that, to ever pay these down. And they're probably going to be about the same amount of interest that they've paid as what they've borrowed. Okay. So here's some simple things you can do. Again, let's think outside the box, right? Let's think outside the box and stop doing the traditional things you're doing and think about it differently. So part of velocity banking would be an example like this. So if we have a Bank of America card at $3,200 and our payment is $94, okay, and it's at 23%, and we have a Wells Fargo card then at $4,600 and that payment is $123, but yet the interest rate is 20%. So we have a gas, okay, so part of these expenses, and I'm just doing an abbreviated version here, right? This is just an example. So part of our total expenses includes gas and groceries. We got to eat and we got to put gas in our car to go to work and to do all the fun things we want to do. So we're going to spend this no matter where it comes from, whether it comes out of our checking account or if it comes out of a credit card. We're spending it every month anyway because we got to eat and we got to get places, okay? So if in this scenario, this person did something just a little different and thought outside the box, we could do this. We know that we have a $3,200 card. If we were to put our gas then on that card, okay, and it drops our payment immediately down, or drops our balance immediately down to $3,000, we've done a couple things here. Number one, we've put a chunk payment down on our card because that monthly payment was only $94. And number two, we've reduced our balance, okay, which drops our average daily balance that we know this is configured on, which means our interest then is lower. So what happens then and how do we create cash flow for ourselves? Well, hold on a second. So now we have that second card, okay? We've got a Wells Fargo card and it's at $4,600. And again, we've got gas and we've got groceries. So we're going to put our gas then on the smaller card, the Bank of America card, and we're going to put our groceries, the more expensive monthly expense to us, on this Wells Fargo card. Okay, so $4,600, we drop it immediately by $600, which drops our balance to $4,000. Again, the cards are configured on an average daily or simple interest, which is an average daily balance, okay, which means that every day that goes by, the bank is looking at those balances and they're averaging it, okay? So when you come in and make a chunk payment such as this, it drops that balance immediately. And then throughout the month, you're going to charge your gas out and you're going to buy your groceries, okay? So that's what this person is going to do. So what happens to that credit card payment? What happens to those card payments here? Well, this payment is no longer, and this payment is no longer because we have satisfied that payment. So when you bank this way and you run your banking through cards like this, so this is a split card example, okay? You are actually eliminating this payment and it's coming back to you as cash flow. So here they are at zero cash flow, right? And now, because they have done this and they've done this, they added cash flow. They added $94 in cash flow here. That's going to then pay this card down for them by $94 a month. They have then added $123 to this card, and they're paying their card down now by $123 instead. Okay. Well, you've got interest in there too, so you have to calculate some interest there. But essentially, these are coming back to them as cash flow. They're no longer payments that they owe because they've hit their card above and beyond that payment and dropped their balances. So now you've done a split card strategy, right? And you're going to run the rest of your chargeable expenses out of these cards, and you didn't get another job, and you've given yourself a raise, right? So that is what is so amazing about velocity banking, and that's why Dan and I shout this from the rooftops for people, because it's incredibly powerful. Just changing what you do with your money has made all the difference in the world for this person, right? Because now they weren't really paying their balances down by much because they were paying, their interest plus 1%. Okay, so that's what these represent. Your cards will calculate interest a little bit different on how they want your minimum payment. It's usually 1% plus the interest and 1% of the outstanding balance. Okay, so 1% of the interest plus your interest rate. So they're going to pay this card down now by not getting another job, simply by rearranging what they're doing with their money. Instead of parking it into their checking account, they're parking it onto that card. So they're making a payment above and beyond that to get them there. Okay, so pretty powerful stuff here when you really think about it. So now let's talk about one of the examples here that I think is really fantastic and really cool, because I know a lot of people out there set those 401k contributions and then they kind of forgot about them. All right. So what could this mean for somebody? What could it mean? Well, in the example that I'm going to board out for you today, all right, it could mean a lot. So we're going to first address, sorry, I skipped ahead. We're going to address number 2, which was trimming the fat. What can you live without? Again, that's going back to all those unnecessary subscriptions and cutting those out, trimming the fat, and you're going to find cash flow in the process. So really dive into what you guys have going out, and you're going to find cash flow for you, okay? And number 3, that is the one I want to talk about today, because that's the boarded example that I have for you. So we're addressing number 3, 401k contributions. What are you set at? Are you set at 5%, 10%, 15%, 20%, maybe 25%? Maybe you set it so long ago before you had kids that you really didn't even pay attention anymore. You don't even know. So that being said, let's use this example, okay? So my example is going to be of a gentleman who has an income of $5,250. That's his income. Right now, his total expenses are $5,264, which means that he's actually negative by $14, okay? Life happens, right? We know that every month life comes up, things happen, you got to pay for extras. And so a lot of times the cash flow that you had is diminished a lot, right? It's diminished greatly. Well, in his case, he had life happen and his cards kept getting higher and higher and higher. And so now he's negative and he's got to do something, right? He knows he has to do something. And that's what brought him to our doorstep, because he's like, I heard that I could just rearrange some things. I'm not sure exactly how to do this, and I just want your help, right? So instead of watching videos, he wanted our help, which is fine. I'm happy to help you guys. All right, so he's contributing 20% to his 401k. His company match is 6%, all right? So that's great, or is it? When you're in debt and you have significant debt, you guys need to be careful about how much you're contributing, because that extra money, even though it may seem, so if he's paid bi-weekly, right? He's paid bi-weekly. No, he's paid bi-monthly. Sorry, he's paid bi-monthly. So when he broke it all down, he's like, well, it really isn't that much overall that I would be saving. So I really didn't think about it. Well, when you look at it on a monthly schedule, right, it's a lot more. So if you are in debt, you need to take a look at this, right? So if you back off your contribution to 6%, so you're getting your company match, so really you're at 12%, right? So now you've got 12% going into that 401k, all right? So he's going to gain, if he backs off to 6%, he's going to gain 14%, which is significant. And that means that he's gaining $735 just by backing that contribution off. So if he does the 735 minus the 14 that he's negative, that means he's got 721 as his new cash flow. And that made all the difference in the world to him. So let's go ahead and we're going to see this, right? So he went from negative $14 to hero just by making a simple change. And so that's what I'm going to show you right now. Okay, so now we have our scenario, right? So it's all boarded out for you. We know that this guy had his 401k contribution at 20%. So we then ran 2. If we didn't use the 401k contribution backed off to 14%, and then what it would look like if we did use the 14% contribution that would come back to him. So now we know he has a negative cash flow of $14, right? So he's negative $14. Here's the rundown on his, so he's got a mortgage, and the mortgage is $1,348 a month. He has 2 cars, and one is $610 and one is $490. So that's what he's paying monthly for those. He's got a personal loan out there for $17,240. It's at a 310 payment. He has a home equity loan for $33,681, and the payment on that is $680. That's for 5 years, and that would cost him $7,102 at a 7.8% interest rate. This here would cost him, because I missed this, the personal loan would cost him $5,135 after 6 years at a 9%. Then we go down to Wells Fargo. He owes $16,810. The payment is $508 a month. It's at 5 years, and it's $11,247 to pay that back at a 24.24% interest rate. Then we've got Discover at $82.96, so $8,296 is what he owes, and his payment is $166. It is for 9 years if he lets that run out, and it would cost him $9,673 to finish that. Then we have Capital One at $5,642, and the monthly payment on that is $112. That would take him 16 years to pay off, and at $16,776. So in this scenario, he already has a home equity loan out there. Okay, so here's a home equity loan. It's at $33,000. So we had to come up with a way to help him out. So when we took a look at his mortgage and the potential appraisal of the property values, we thought, okay, you could do a home equity line of credit, and you probably at this point could get more money for it. So he was able to, right? So he went out and he refinanced his personal loan, right, into a line of credit, and he got more for that line. So he was able to get a $61,000 home equity line, and it's going to cost him 11.625%. And everybody's freaking out, right? Because, oh my gosh, 11.6% is way more than the 9% that he's currently paying. But he's going to save a lot more over time. So that 9% versus the 11%, I don't even bat an eye at, and you won't either. Okay, so what we do then is, remember, when you do velocity banking, you're going to park your paycheck right in to that line of credit. So what that means is your paycheck comes in, hits your checking account for about a minute, and then you make a payment to that credit card, to that home equity line of credit for the entire amount of the payment. Of the entire amount of your direct deposit, because you know you can use that to pay all of your expenses out of every single last one of them. We don't have to hold anything out as being non-chargeable, because home equity lines of credit can pay everything through that checking account once they're connected like that. So all of your bills get paid through the checking, and the line of credit comes in and covers right behind it, so long as it's hooked up that way. Sometimes you have to manually move it, and then your expenses will be paid that way, but it's the line of credit that is coming into your rescue, and you've made a chunk payment then onto that line of credit. All right, so now what we're going to do is we're going to then be able to subtract out the lines that we've or the loans that we've chosen, loans and lines that we've chosen to take care of. And we aren't going to be able to take care of all of them, right? Because the total amount debt would equal more than what he has available to him. So he couldn't take all of it. But he can take a part of it, and he can take a big part of it. Okay. So the total debt cost right now that it would cost him to pay all of these off in interest is $49,933 if he lets all of this run out. Okay, that's what currently the trajectory that he's on, it would cost him that. But we are going to do things differently. Now, when you're looking to pay through this, looking to use velocity banking, what you're going to do is you're going to pick the largest payments that are going to offer you or afford you the most in cash flow. Okay, so that's going to free up the most money. And so in this situation, you have to pick and choose, because remember, we have 61,000 to work with, and we don't want to take them all the way up to that 61, but we're going to get close, because we know that when we pay some of these off, we're going to have available lines to us if we need cash. So we've then chosen to take care of the home equity loan, of course, Wells Fargo and Discover, because those together are going to give us the biggest amount of cash flow available to us once we take care of those. Because remember, these payments will no longer exist to us so these payments won't exist anymore, because they're going to come back as cash flow, because we're overpaying those every month, right? We're overpaying them. So they're gone. All right. So those are all gone, and we're overpaying them because we're putting them right into this line of credit. So now we're going to go ahead and run these two. Okay. So this is without using that contribution amount, okay? So when he uses the contribution amount, he's going to be able to add back $735, okay? That's what he'll add back in. So right now we're going to run the first scenario. So what we're going to do then is we're going to take and park our paycheck, which is the $52.50, okay? That's his income. So he's going to park that paycheck right in there, and that then is going to help work these down, right? So he drops immediately to $53,537. Immediately, that's what it drops to. Then we have to add in our charges, our monthly expenses, right? Because we're using it as an expense account. We're taking all of our charges now, all of our charges. We got rid of these. Remember, these payments don't exist anymore. So this is our new expenses. Okay, so minus these payments. So our new expenses is $39.10. And then we have to figure our interest rate, right? Because we still have an interest rate on this line of credit. And we said that it was 11.625. So to calculate this interest, okay, so what we're going to do then is we have to add our high balance and our low balance. We add them together. We divide them by 2. That gives us an average. Because remember, simple interest is what we're paying here, and that is calculated on an average daily balance. So to get that, or to get as close to that as possible, we add our high, we add our low, we add them, divide them by 2. We get then a number that we can work with. That number then we're going to multiply by 0.11625, okay? And that will give us a year's worth of interest at this interest rate, okay? But we don't want a year's worth. We only want 1 month because we know each month we're working this down. So we just need that first month. And that's what these two numbers are going to give us. So we know that the interest we're going to owe is $544 for this dollar amount. So then we then work it down, right? Because we have our interest comes back into the account, and so does all of our expenses throughout the month, which then brings our balance from the $53.57 back up to $57.99. And then the next month comes in, and our income hits at $52.50, drops our balance again to the $52.741, add back in our expenses, we add back in our interest. Remember, the high, the low, added together, divide that by 2, multiply by the 0.11625, and then divide that by 12 to get that month's interest. Okay, so then that's going to give us that month's interest. So if we do that, we're going to then have $57,187 is where I'm going to leave this at so I can finish up and show you. So that will take us 53 months. Okay, it'll take him 53 months to pay it that way, but he saves, but he only spends $16,191 in interest. Okay, we know the total amount of debt for this interest, okay, for these debts is $28,022. Remember, we do have other expenses out here, interest that we have to pay, but we're not paying it right now. We will take care of that a little bit later. But right now, he was able to then do this in 4.4 years. His debt interest, again, was the $28,022, but when you subtract the interest that he had to use to get this taken care of, that means he saved $11,831, and he did it in 4.4 years, which is significant because it was going to take, through all of this, 9 years on one, 16 years on another, 5, and 6. Now, once he gets these balances dropped enough, he can then start pulling in some of these other debts and get those taken care of, right? So once he drops his balance enough, he can pull in the $56.42, then he can pull in, whatever else we had left over, which is our personal loan there, and take care of that. Okay. So again, in order to figure out which payments you're going to use and to put into this, you have to figure out which one's going to afford you the most cash flow. And those are the ones you start with. All right. But then he can pull the other ones in once he pays it down enough. Okay. So this is what he has done without using that contribution. Now, if he backs off that contribution and he frees up $735, this is what it then looks like. So we start with our $58,787. We bring in our income, which is now $59.85, remember, because we added the $735 back in. And so now it drops his balance immediately to $52,802. Then our expenses come out, then our interest, just as we calculated before. The high plus the low, added together, divide by 2, multiply by our 0.11625, and that gives us 1 year of interest, but we want the 1 month only. So you're dividing that then by 12 to get the 540. And you can already see this is $4 less, right? Because we have more income. And so then after those come back in, right, the expenses and the interest, we're at $57,252. Then our income hits again. We're down to 49,717. Again, you calculate your interest, your high plus your low gives you the 525, and then you add in your expenses, and so we're back to 55,702. But we've dropped it in 2 months from 58 to 55. This only takes him 30 months, you guys. So 30 months is all it takes for him to take care of this debt when he backed off that contribution. And so now he's saved, right? $18,914, and it only cost him $9,108. Now, again, at this point, he can pull in these other debts, or at some point in this, and you just have to run it down, right, to figure out where you can start pulling in your Capital One card and your personal line of credit at that point. I'm sorry, your personal loan at that point to take care of those. But he's done himself a significant savings just by backing off that contribution. Once it's all done and over, he can bump that baby back up and he has cash flow because he's then taking care of all of his debt. So take that, learn, use the thinking outside the box, right? Start thinking outside the box. Think about other ways that you can use to run velocity banking and free up cash flow for yourself to then save yourself a whole lot of money in the long run. Love velocity banking, you guys. I absolutely love it. And I love this scenario. You guys, he was thrilled. He was absolutely thrilled because he totally forgot about how much he had contributed or was contributing. And so he said, you know, it's not going to hurt me at this point. I can back that off. And then as soon as this is over with, I can bump it back up and I'm good to go. And he will be. Think about that. He'll have more cash flow after all of this then, where he can do other investments if he wants. Maybe he's going to buy properties, and maybe he's going to then have rental properties and rent them out, or maybe he's going to buy gold and silver, or maybe he's going to buy crypto, or invest money in the stock market. Whatever he wants to do at that point, that is his prerogative, and that will be your prerogative too. Keep learning, guys. Keep coming back, and I will keep bringing it to you. Have an awesome day. See ya.